Hi, welcome back. In this session, I'd like to talk about two large social media companies that are probably parts of your life that I've been following for the last few years, and I've learned a great deal about valuation from them. The two companies I'm talking about, of course, are Facebook and Twitter. I'll tell you up front that I'm not a great social media user. I don't post on Facebook. I hardly ever visit Facebook, and I didn't even know what it meant to be poked on Facebook until my son explained it to me. But it is obviously a part of most people's lives. Twitter, on the other hand, is a company I do use, but my 820 tweets over my entire lifetime is nothing compared to what some people tweet out in a month. But these are two companies that actually illustrate divergent paths. In fact, if you look at the last 2 years and you look at what Twitter and Facebook have done, the numbers speak for themselves. Twitter's down about 68%, Facebook is up about 55%, and the market was up only 4%. So Facebook was the winner, Twitter was the loser. And during the course of this session, I'd like to take a deeper look at these two companies using the most recent earnings report again as a vehicle to illustrate what they share in common and what they might have as differences. So let's start with Facebook. In its most recent earnings report, Facebook reported numbers that beat expectations on almost every single dimension. They had higher earnings per share than expected. They reported higher revenues than expected. They had more users than expected. Amazing if you think about the fact that they have 1.6 billion users, 1.59 billion users, and they also reported almost 1.44 billion of the 1.59 billion were mobile users, which is in fact a huge jump forward for the company, which could not do mobile when it first went public. And it also, and this was I think the icing on the cake, it reported that the revenues it made per user was $3.73, which was about 30 cents higher than what analysts were expecting it to make per user. So in every dimension, the stock beat the numbers. It's worth noting that Facebook has actually beat earnings expectations pretty much every quarter for the last 8, and the market's ignored those changes. Sometimes it's gone up, sometimes it's gone down. On this particular report, though, the market really liked the report. The stock jumped about 14%, and again, to put it in perspective, the market cap of the company increased by more than 40 billion. Now, before I look at how the earnings report changes my narrative, I'm going to take you back in time to 2012, May 17th of 2012 to be specific. It was the day before their IPO, and I knew the pricing was coming out. It was actually the day that the pricing was going to be set for Facebook at 4 p.m. I decided to value Facebook on that day. Now, this is a trip down memory lane, and you can take issue with my numbers as much as you want, but on May 17th of 2012, I valued the company at about $27. Now, if you look at the story I was telling about Facebook in 2012, I was describing it as an incredibly successful online advertising company, but the way I described it was I called it a Google wannabe, a company that would trace or track Google and how quickly it grew, but wouldn't be quite as successful as Google. I saw Facebook growing to have about $44 billion in revenues. I saw its margins decreasing over time because of competition, and attaching a risk to those numbers, the value that I got was $27 per share. Now, since 2012, I've revisited this valuation multiple times. And I have to tell you, each time I value Facebook, the value's gone up. Why? Because the company keeps changing my perspective on what it can do. Each time I look at it, it continues to impress me by how much it continues to grow, how well it delivers profits, and how it's starting to, in fact, do much better than what I thought it would do in 2012. Instead of being a Google wannabe, I think this company now has the potential to be bigger, more profitable, and more valuable than Google. That's saying a lot, but in my story, this is what happened. In 2013, when I valued Facebook, the value that I got was about $38 to $40. In 2014, when I valued Facebook, it was up to about $65. In 2015, November of 2015, when I valued Facebook, I got a value close to $80. The story that I've told has also shifted over time. The narrative I was telling at the time of the last earnings report was of an online advertising company that was using its social media platform to full effect, essentially able to grow its revenues at these astonishingly high numbers while delivering outlandishly high margins as well. So that was the story I told coming into the earnings report. Looking at the earnings report, I got only more impressed. So basically, there's a little tweak in the story. The tweaks are positive. And with those tweaks, a slightly higher revenue growth and potentially a slightly higher sustainable margin, the value that I'm getting per share for Facebook after the earnings report is about $95. A little lower than the 102 it was trading at, but if you look at the simulation that I did, you can see very quickly why the way I would describe the company right now is it's close to fairly valued. You could look at the distributions and you can see there's a lot more potential upside than downside. Stock could potentially be worth $150, $160 per share, perhaps even more. But at least based on what I see in the company right now, it looks like it's fairly valued. A little personal note here. I did buy Facebook about 3 months after it went public, after a particularly bad earnings report. Its very first earnings report on the stock dropped to 18. I would love to tell you that I knew this was the bottom, but I just got lucky. It happened to be the bottom. I held the stock, and then I'll make a confession for those of you who are going to attach market timing skills to me. I sold it at 45. At 45. Okay. I made a lot of money, but think of how much money I've left on the table. At the time when I sold it, I backed it up by pointing to the valuation in 2013, which was, hey, you know what, I think the stock's worth only about $40. At 45, it looks fully priced. And it's interesting how my value perspective has shifted. And I'll come back and talk about it because clearly I sold too early. But I have no regrets. It is what it is. But that's my Facebook narrative. Let's turn to Twitter. Its most recent earnings report contained bad news. Bad news on every single dimension, you would think, but mostly on the user dimension. The number of users at Twitter essentially stayed stagnant. Not good for a company that kept pushing for more users for much of its life. Its earnings per share and revenues actually came in. The earnings per share came in higher than expected, and the revenues came in at about the number you'd expect. I do have to point out, though, that the earnings per share for both Facebook and Twitter, I think, are completely distorted by the adding back of stock-based compensation expense and the tricks that analysts played to come up with adjusted earnings. That said, the fact that users came in stagnant was, in fact, the piece of bad news that the market latched onto. And the fact that Twitter gave guidance, saying that earnings in the next quarter would be lower than expected, was almost a death knell for the stock. The stock dropped 11% on the announcement, a drop in value of about $1.2 billion, and the stock hit its lifetime low right after the earnings announcement. Now, to give you my Twitter story again, I'm going to go back to 2013. October 27th of 2013, again, the date just before Twitter's IPO. I'd valued it then at about $18 per share, based on the assumption that Twitter was going to be a successful online advertising company, but a secondary online advertising company. Why? Because the 140 character limit basically meant that no advertiser would use Twitter as their primary advertising venue, but they would use it as a secondary advertising venue. That combination of improved revenues, in this case not as large as Facebook, because I don't see the market share of Twitter, even in 2013, of going to that level, plus an improved margin, gave me a value that you see of $18 per share. So it was a story that I thought had some core optimism to it. And I've tracked Twitter ever since. And the interesting thing about Twitter is, unlike Facebook, where my value kept going up and up and up each time I looked at it, with Twitter, my value stayed pretty much frozen from 2013 through 2015. 2015 had a brief period of optimism, perhaps misplaced, when Jack Dorsey became CEO, that somehow he would find a way to monetize the user base, because the story for Twitter, amazingly, stayed the same. Right from the beginning, the story was its biggest asset is the user base. If it can ever figure out a way to monetize the user base, it could be a valuable company. But that's the same story I kept telling quarter after quarter. So let's look at the most recent earnings report and see if it changes the story. Before the earnings report, my story was that Twitter's biggest asset is its user base. But because of its social media format, it was going to be difficult for Twitter to become a primary advertising source. I saw it, even if it was successful, as a secondary advertising source, but profitability, reflecting the fact that its costs are pretty low. After the earnings report, I probably got a little more depressed about Twitter's future, because if anything, Jack Dorsey seems to have not done much at the company, and in fact might have made things worse with some of the actions he's taken. Maybe I'm just being short-sighted, but post-earnings report, I see at least the possibility that this company could go into one of those debt spirals that you see young companies go into, especially with technology companies, where the perception that the company is not going to do well drives out employees and customers and advertisers to other venues. A particularly dangerous place to be when your competitors are called Google and Facebook, predators who are just waiting for any sign of weakness on your part. So if I value Twitter post earnings report, the value that I get, just about $17.50 to $18, is roughly the value that I got 3 years ago. In fact, in a very weird coincidence, the price per share for Twitter at the end of yesterday was $17.36, I said. But don't view that as any sign that I got the valuation right 3 years ago, because if that value were right in 2013, the price yesterday should have been closer to 25 or 26, because the price should have gone up. The $17.36 that I got 3 years ago should have gone up, and it did not. So in this case, post earnings report, the value is 18. At the time that I did this valuation, the price was 16. It looks slightly undervalued, and even that was small consolation, because making this personal again, I did buy Twitter on that brief note of optimism that I felt the middle of last year when Jack Dorsey had come in, and I'd actually given Twitter a value of $24 to $25. I actually bought Twitter on the assumption that there's more upside than downside. Well, I was certainly wrong in that. I'm seeing a lot more downside than upside now. But at the moment, I see no reason to do anything differently now. At $18 per share, which is where the stock was trading at today when I was doing the webcast, it looks close to fairly value. The fact that I've lost a significant chunk of money, 28%, is bad news for me. But selling now is not going to make that 28% back. I do think that I will pull the trigger on the stock if it goes. I'm not going to wait for it to go back to 25 and try to break even, because that could be a recipe for disaster. I'd probably sell sooner rather than later, so I'm looking at probably a $21 to $22 price at which I'd exit if it gets there. If not, it is what it is. As a postscript, there are the two things that I want to kind of draw your attention to. Over the last few webcasts, I've talked about Alphabet, and I've talked about Facebook, and now I've talked about Twitter. If you focus just on Google and Facebook, or Alphabet and Facebook, if you prefer it to call them that, the way the market is pricing these companies, it's pricing them not just on the assumption that they will win the online advertising game, but that they will be dominant winners. Put differently, if I took the market prices of Facebook and Google right now, and I backed out of this, the expected revenues 10 years from now, I would get revenues of about $300 billion in 2026, which in my estimate would give me about 75% of the online ad market right there with just these two companies. Which raises an interesting question. If these two companies capture 75% of the market, where are all the other advertisers going to go? I mean, where are the Twitters and the Yelps and the Snapchats and all the other companies? So here's how I see these numbers. If you're an investor and you own either Facebook or Google in your portfolio, I understand, because there are narratives you can tell for either one of the companies that would make them the winner and therefore justify the price. If you have both Facebook and Google in your portfolio, I think it's going to be much more difficult for you to justify it, unless you assume that they pretty much take the entire market. If you got Facebook, Google, Twitter, Yelp, and potentially a private investment in Snapchat in your portfolio, I can't see a narrative where you can justify holding all of those companies. The market just isn't big enough. The other thing I would like to add is I've learned from valuing these companies. I've learned a couple of things. One is I learned that I don't adjust expectations quickly enough, that sometimes I'm stuck on my expectations. In the case of Facebook, this happened when I bought at 18 and I sold at 45. Part of the reason I think I sold at 45 is because my value didn't catch up to the narrative until almost a year later. Too late for me to go back and reverse my mistake, but I think I hold on to expectations too long. And I sometimes underestimate the effect that management can have in a company in both good ways and bad ways. In many ways, I think Facebook and Twitter illustrate how much good management can do, example Facebook, and how much bad management can do, example Twitter. So I'll continue to watch these companies. I'm going to continue to learn from these companies. They will be in and out of my portfolio. So this is not the end of the game, and I hope to revisit these companies sooner rather than later. Thank you very much for listening.